First, we have a keynote from the Director of Business Development. Please welcome Alan Helm with Bitcoin for Corporations.
Good afternoon, everybody. How's everybody doing? Good? Awake? Had their coffee? Ready for lunch? I get to talk about a very fun topic today: risk, duty, and long-term strategy. As Tim had mentioned, my name is Alan Helm. I run business development at Bitcoin for Corporations. I'm one of the co-founders of BFC, which was incubated inside of BTC Inc., the parent company to Bitcoin Magazine, with the support and backing of Strategy to be the de facto industry alliance for any company running or about to run the corporate Bitcoin treasury playbook. BTC Inc. has worked with almost every major company in the industry since 2014, and our Bitcoin for Corporations members already control roughly 3/4 of all the Bitcoin held by public companies. So the data, lessons, and case studies you'll see today come straight from the front lines. As corporate executives and fiduciaries, we must ask a few questions when it comes to Bitcoin. Why does Bitcoin mitigate risk and financial debasement for corporations? How can Bitcoin serve as a tool for risk mitigation and long-term resilience? And most importantly, which is the greater risk, adopting Bitcoin or ignoring it? Today, I'll address that through the themes of fiduciary duty, lessons from past failures, prudent versus imprudent strategies, and traits from strong Bitcoin treasury companies, warning signs for investors, and success stories. Let's dive into examining the fiduciary duty of CFOs and why Bitcoin has earned a serious look in corporate strategy. So what fiscal responsibility meant a decade ago, sitting on cash and ultra-safe bonds, does not guarantee safety today. With persistent inflation and aggressive monetary expansion, even the most conservative assets are losing purchasing power. Michael Saylor has famously called idle cash reserves melting ice cubes. As CFOs, CEOs, corporate treasurers, we must recognize that the safety isn't what it used to be. The definition of a prudent reserve is changing in this unstable macro climate. In the past year and a half alone, Bitcoin's price has nearly doubled, vastly outperforming traditional corporate bonds. Even a modest allocation, say 1% of assets, could hedge inflation without jeopardizing core capital. The key point for CFOs is that failing to evaluate Bitcoin is no longer prudent. Fiduciary duty now includes understanding Bitcoin's role as a reserve asset and some integrating Bitcoin into treasury strategy. Done judiciously, many actually reduce long-term risk by guarding against monetary debasement and proving an upside in appreciating scarce assets. As we all know, a CFO's fiduciary duty is to maximize shareholder value, not by increasing profits, but by protecting those profits from currency debasement and inflation. Over the past few years, inflation has eroded corporate cash holdings. U.S. corporations hold hundreds of billions in cash and bonds that barely keep up with official inflation and likely lose value against real inflation. In contrast, Bitcoin's price appreciation has massively outpaced bonds in recent years. We operate in a macro environment where volatility is the norm. Inflation spiked, interest rates seesawed, and even banks that were deemed rock solid have faltered. Surveys have shown that nearly 3 out of 4 large company treasurers have implemented new bank risk metrics after Silicon Valley Bank's collapse. Think about that. Cash in the bank suddenly wasn't so safe. Our takeaway: the old playbook for stability is showing cracks. It's prompting a search for new strategies to safeguard corporate treasuries in the long run. Fiduciary duty isn't about clinging to tradition, it's about prudently positioning for one's future. In today's climate, that means weighing new asset classes. In many conversations that BFC has had with CFOs, these CFOs now ask, how do we not only preserve value, but also ensure we don't miss the next strategic asset that could protect or enhance that value? Bitcoin is emerging as not only one such asset, but as the apex asset. But don't just take it from me. When multiple public companies' chairmen and CEOs state that Bitcoin was the best use of excess cash, such as Saylor, Eric from Semler Scientific, Michael Moe of Cooler, Will Reeves of Fold, and even Fred Thiel of Marathon, it underscores a shift considering Bitcoin isn't just a speculative zeal, it's fast becoming a standard discussion in boardrooms as a legitimate long-term treasury play. So to appreciate a sound Bitcoin strategy, we must contrast it with what not to do. The crypto industry's recent history is rife with poor risk management examples. Let's briefly revisit a few infamous case studies and the lessons they taught us. Real quick, from a show of hands here, who's been in Bitcoin for a year? A few people. Who's been in Bitcoin for 5 years? A few more people. Who's been in Bitcoin for 10 years? 15 years? Probably only Adam back in this room. These examples will be a good reminder of some of you and new examples to dig deeper for others. Let's start with FTX. FTX's implosion in late 2022 showed how a lack of transparency and misuse of funds can destroy even a large business overnight. FTX appeared to be a superstar crypto exchange, even bailing out others like BlockFi and Voyager early in 2022. But in November of 2022, a leaked balance sheet revealed that their sister firm Alameda Research depended heavily on FTX's own token, FTT, as collateral. This house of cards collapsed when confidence wavered and investors rushed to withdraw funds, only to find FTX had misused customer deposits for risky bets, creating an $8 billion hole. Within days, FTX froze withdrawals and filed for bankruptcy on November 11th, 2022. So the takeaways here. Commingling funds, lack of basic internal controls, and opaque finances are fatal flaws. Even a charismatic CEO or big-name backers cannot save a firm that ignores fundamental fiduciary principles, such as segregating assets or honest accounting. For corporate officers, FTX is a warning that any Bitcoin or crypto custody solution must be transparent and strictly governed. Three Arrows Capital. This was a crypto hedge fund that leveraged itself into oblivion. 3AC borrowed hundreds of millions from various lenders, such as Voyager and Celsius, chasing high-yield bets. When the Terra Luna stablecoin collapsed in May of 2022, it triggered a chain reaction of losses that 3AC could not recover. They failed to meet margin calls and defaulted on a $3.5 billion loan owed to over 20 creditors. In short, poor risk management, recklessness, excessive leverage buried 3AC under a pile of loans. The lesson here, excessive leverage is a double-edged sword. It amplifies gains in good times, but it can turn modest market corrections into devastating crashes, as we've seen in traditional finance crises as well. A fiduciary should never put the company in a position to where a single market downturn can wipe it out. Next, let's look at BlockFi. BlockFi was a prominent crypto lending platform that found itself entangled with both 3AC and FTX. Internally, BlockFi's culture prioritized aggressive growth over risk management. Employees were even discouraged from putting risk warnings in writing. BlockFi had lent heavily to 3AC and Alameda, creating concentrated borrower pools. Management waved off concerns because loans were collateralized, but that collateral evaporated in the 2022 market crash. When 3AC defaulted, BlockFi got a lifeline from FTX, a $400 million credit line in July of 2022, only to then lose $355 million stuck on FTX and other platforms. BlockFi went bankrupt, with executives later admitting lapses in risk oversight. The lesson here, concentration risk and counterparty risk can be deadly. No matter how reputable a partner seems, fiduciaries must assess what happens when that partner fails. Diversify counterparties, stress test liquidity, and never assume too big to fail. BlockFi learned this too late. Lastly, let's also look at the ICO mania of 2017. Countless startups issued their own tokens. It was an era of speculative frenzy and minimal due diligence. The result, nearly half of all ICOs launched in 2017 failed completely. One study found that only 44% of ICO projects survived beyond 4 months after their token sale. Investors lost money in scams or ideas that never materialized. The broader point here, most token projects carried extreme risk, and unproven illiquid tokens are unsuitable for a corporate treasury. Unlike Bitcoin, which has 15 plus years of history, a robust network, and clear monetary properties, ICO tokens were often just ideas with no product. For CFOs, the ICO era underscores why we focus on Bitcoin and no other asset. In all these cases, 3AC's leverage, FTX's fraud, BlockFi's concentrated bets, and the ICO bubble, the common theme here is poor risk management and deviation from fundamentals. As fiduciaries, we must do better. So next, let's discuss why certain popular crypto strategies like lending programs or staking schemes introduce unacceptable risks that prudent stewards should avoid. It's tempting in the Bitcoin and crypto space to seek yield or innovative, quote, financial products on top of Bitcoin. You'll hear about lending out your Bitcoin for interest, staking crypto for rewards, or tokenizing assets to unlock value. However, a corporate treasury with a long-term mandate, these can introduce unacceptable risks. Let's start with crypto lending products. Earning 5% or 10% yield on idle Bitcoin sounds attractive, but consider how those yields are generated. Typically, it means lending your Bitcoin to an often unregulated counterparty. We saw platforms like Celsius Network offer extremely high interest on deposits, 17% or more, far above any traditional yield. It turned out to be a too good to be true scenario. Celsius had an opaque and unsustainable business model. They were using customer assets in risky ways. When the market turned and users rushed to withdraw after the Terra Luna collapse, Celsius faced a liquidity crisis. They froze all withdrawals and ultimately went bankrupt. And in July of 2022, they owed investors $2.5 billion. The lesson, these generous yields came with hidden risk, effectively turning off access to your own treasury assets. As a fiduciary, losing liquidity in a crisis is unacceptable. We must ensure Bitcoin funds are available when needed, not locked in a failing lender. Now let's look at staking and yield programs. Some cryptocurrencies allow staking, locking up tokens, or supporting network operations in exchange for rewards. While Bitcoin itself does not require staking, some companies consider staking in other crypto assets or participating in yield farming. For a corporate treasury, this is generally not worth the risk. Staking often requires locking assets for a period of time, and if done through a third-party service, it introduces custodial and smart contract risk. We've also seen regulators raise questions around staking programs. In the SEC and in the US, they have penalized companies for offering staking as a service. Without proper compliance, considering some of these programs are unregistered securities. The bottom line, any marginal yield that comes from staking other assets is accompanied by significant legal and technical risk. A conservative strategy would avoid chasing a few extra percentage points that could backfire badly. Lastly, tokenization and complex derivatives. The idea of tokenizing real-world assets or creating a corporate token is frequently pitched as cutting edge, but complexity is the enemy of clarity in treasury management. Issuing an internal token or using exotic crypto derivatives can muddy the waters of your balance sheet and introduce regulatory uncertainty. Recall the ICO craze. Creating a token can invite legal scrutiny, securities law, etc., and distract from the core strategy. Unless there is a very clear, compliant use case, these schemes are more trouble than they're worth. For most corporations, a straightforward approach, owning Bitcoin directly on the balance sheet, is the cleanest and safest way to gain exposure. Adding layers of complexity, such as loans, token emissions, algorithmic stablecoins, etc., can stack up unknown risks. The collapse of Terra Luna's algorithmic stablecoin in 2022 is a cautionary tale. Innovations that aren't time-tested can fail abruptly. In summary, Bitcoin itself is the innovation worth focusing on, a pristine collateral and reserve asset. We don't need to get cute with it. Avoiding yield traps, illiquid staking, and dubious token schemes is part of a fiduciary risk management's duty. Instead, holding Bitcoin in a secure way or using well-regulated custodians is the prudent path. So what does a prudent Bitcoin corporate strategy look like? Let's outline the traits of a strong Bitcoin treasury company. Not all companies approaching Bitcoin are created equal. The ones that succeed in the long run tend to share common traits in how they govern and execute their strategy. Here are 4 key characteristics of a robust treasury operation. Long-term mindset. Successful Bitcoin treasury companies adopt a multi-year or multi-decade perspective. They view Bitcoin as a strategic reserve asset to hold, not to trade impulsively. This long horizon lets a company weather volatility and turn that volatility into vitality. A strong Bitcoin company sets policies like, we won't sell for at least X years, or we will target holding Y percentage of assets in BTC regardless of price swings, indicating commitment. This mindset also means understanding that Bitcoin can be volatile quarter to quarter, but over the span of 5-10 years, it has always trended dramatically upward in value. Strong governance and oversight. Corporate Bitcoin adoption should involve rigorous oversight by the board and risk committees. There must be clear policies on allocation limits, how purchases are executed, and how custody is handled, so on and so forth. A good example of governance was how Strategy communicated its strategy methodically to shareholders. It started with modest allocations and used experienced regulated custodians and exchanges for execution. Strong governance also means segregation of duties, such as multiple approvers for moving any funds, use of multi-signature wallets, transparent accounting, and regular disclosure of holdings, as we see with public companies announcing their BTC buys on a regular cadence. Essentially, treat Bitcoin with the same seriousness and internal control as you would cash, because it is cash, just in digital native form. Companies that excel here often have a dedicated treasury committee for Bitcoin and integrate their legal, compliance, and audit teams into the strategy early. Lastly, transparency and public accountability. The best Bitcoin treasury firms are open about their strategies and results. Since Bitcoin is often a contentious topic, believe it or not, being transparent helps gain shareholder and stakeholder trust. This includes public disclosures of Bitcoin holdings and financial statements, informing the investors of rationale and risks. We've seen firms issue detailed shareholder letters or host webinars or explain why they hold Bitcoin. Transparency also extends to how they secure their Bitcoin, whether they're using a third-party custodian or self-custody with multi-sig. Stakeholders should know their assets are safe. For instance, when corporations often partner with qualified custodians like BitGo, Coinbase Institutional, NYDIG, so on and so forth, and can state that clearly, that institutes stakeholder trust. When Strategy began buying, they communicated it extensively and even now publish their total holdings with each quarterly report. Lastly, conservative capital strategy. Interestingly, conservative here doesn't mean avoiding Bitcoin. It means managing growth and leveraging cautiously. A strong Bitcoin treasury company typically avoids high-risk tactics like using Bitcoin as collateral for unstable loans, or if it does borrow, it does so in a measured way. They maintain healthy liquidity buffers, cash for operating needs, so they're never forced to sell Bitcoin at a bad time. They also align the scale of their Bitcoin investment with their corporate profile, such as not betting the entire farm overnight. Gradual accumulation, dollar cost averaging in, as some do, and building a position over time can be a prudent approach. Also, conservative strategy might involve matching Bitcoin purchases with long-term financing. Some firms have issued long-term debt or even Bitcoin-backed bonds to raise money to buy BTC, locking in capital for years so there's no short-term squeeze. The focus is on survivability. You want to survive any 50% drawdown in Bitcoin's price without distress. Companies like MicroStrategy have used equity and low-interest debt to fund purchases, but most importantly, most of that debt was unsecured or convertible, meaning no margin calls on their Bitcoin holdings. That was intentional to avoid a forced liquidation risk. In essence, a strong Bitcoin treasury company behaves a lot like an old-school hard money reserve manager. Think of how central banks treat gold with careful custody, patience, and risk awareness. These traits set up a company to recap Bitcoin's benefits while mitigating downside. Now, from an investor or partner perspective, what red flags might indicate that a Bitcoin treasury company is actually taking on too much risk? Whether you're evaluating a vendor, a potential investment, or even your own company strategy, watch out for these warning signs. Over-leverage or excessive debt. If a company has borrowed heavily to buy Bitcoin, especially if debt is short-term or has margin call provisions, be cautious. Prudent use of debt can amplify returns, but over-leverage is dangerous, as seen with 3AC, which used extreme leverage and collapsed. A red flag is if the firm can't sustain a big drop in Bitcoin price without hitting a crisis. Healthy firms set conservative loan-to-value ratios and have contingency plans. If you hear about complex lending arrangements or see debt levels climbing fast to fund Bitcoin buys, ask for details. Over-leverage can turn a sound strategy into a ticking time bomb. Illiquidity and poor liquidity management. Another red flag is if the company's Bitcoin is locked up in ways that it can't be accessed in an emergency. For instance, if they deposited most of their BTC into illiquid investments or long-term staking contracts, that's concerning. What we saw with Celsius and others, that locking up customer assets can lead to catastrophe when withdrawals were frozen. Good treasury strategy keeps funds accessible, such as locked in cold storage, but available within days, not locked for years. If a company can't quickly liquidate a portion of their BTC or has most of it pledged elsewhere, their treasury might not be as robust as it appears. Liquidity is king in crisis moments. A well-run Bitcoin firm knows that. Complexity and opaqueness. Keep it simple is generally a virtue in corporate finance. If you come across a Bitcoin treasury company that has convoluted corporate structure or uses a lot of jargon you can't follow, such as fancy yield strategies or synthetic tokens, layered smart contracts, be wary. Complexity often implies risk hidden in the fine print. For example, Celsius's business was so opaque that not even savvy users found it hard to pinpoint how they generated yields, which in hindsight was a huge red flag. Similarly, if management can't plainly explain their Bitcoin strategy, that is a problem. Transparency issues, not disclosing where the Bitcoin is custodied or how they value it on their books also fall here. You want clarity, not smoke and mirrors when it comes to safeguarding assets. Lack of proper governance controls. Red flags include company boasting about being crypto cowboys or skirting compliance. For example, if risk officers or compliance staffs keep quitting or are absent, run. In BlockFi's case, executives dismissed risk professionals' concerns and even discouraged documenting risks, a surefire sign of trouble. You want to see robust risk management culture, internal audits, security testing, regulatory compliance, and adhering to accounting standards, licensing for any financial services. An absence of these is a warning sign that the firm might repeat the same mistakes of FTX or BlockFi. In summary, if you observe any of these red flags, over-leverage, illiquidity, needless complexity, or weak governance, it is wise to either steer clear or demand changes. A Bitcoin treasury strategy should not look like a wild speculative gamble. It should look boringly sound, just like Bitcoin. The good news is that we have positive examples in the market of companies executing well. And in the interest of time, we're going to speed through these. Strategy, the most well-known. Core software business that was flat in excess cash in 2020, earning less than 1% yield. CEO Michael Saylor saw USD money supply ballooning and called cash a melting ice cube. Board authorized Bitcoin as the primary reserve to outrun inflation and generate optionality. You can see they now own over 2.6% of the entire Bitcoin in supply, over 592,000 Bitcoin. The blockchain group. In late 2023, they were a legacy consulting unit that was stagnating. Share price just languished. The new board concluded that idle euros were eroding and EU investors had no local Bitcoin proxy. They rebranded as Bitcoin's first Bitcoin treasury company to capture premium equity demand. Their Bitcoin stack now is over almost 1,700 BTC after a 17 million euro purchase on the 18th of June. Their funding playbook, equity placements consistently priced at a premium to market, plus a 300 million euro ATM mandate and BTC-denominated convertible bonds. Their market impact, share price has exploded over 1,400% in 6 months. BTC yield for 2025 stands at a staggering 1,173% as the firm converts dilution directly into Satoshis. The lesson here, shareholder alignment, published BTC yield, hit the milestone, raise again. French investors have rewarded the clarity with the sky-high valuation. Metaplanet. In 2023, they were a former hotel tech roll-up, crushed by COVID and a weak yen. Management saw Bitcoin as a digital hard yen to escape domestic currency debasement. They pivoted to Bitcoin to be a Bitcoin-centric holding company model, branding it itself as Asia's MicroStrategy. Their Bitcoin stack is now over 10,000 BTC, even overtaking Coinbase to become the world's 9th largest corporate holder and a clear leader in Asia. Their funding playbook, daily DCA moving strike equity program that puts a 210 billion yen multi-trans bond itself. Their target, 210K BTC by 2027. Their market impact, their stock is up over 2,000% since adopting the Bitcoin standard in 2024. Year-to-date, 2025 BTC yield is up 266%, achieved with zero bank debt. The lesson here, geography is no barrier. Conservative Japan now hosts a company using traditional bond markets to build a mega-sized Bitcoin reserve. So as I wrap up, I want to leave you with this thought. What was once seen as risky, Bitcoin, is increasingly viewed as responsible in the long run. The irony is that as Bitcoin matures, the greater fiduciary risk could be to ignore it completely. Your job as stewards of capital isn't to shun all risk, but to manage smart contract or smart risk in pursuit of reward. We've seen companies transform their treasuries and thrive. We've seen shareholders respond positively to well-governed Bitcoin strategies. The tools and case studies are there, so ask yourself and your team, do we have a Bitcoin strategy? If not, what's your plan if Bitcoin continues on its adoption trajectory? Remember, the goal isn't to bet the company, it's about future-proofing it. In unstable climates, as we discussed, traditional tactics alone won't suffice. Embracing innovation and measured steps is our duty to ensure long-term prosperity. Thank you.